Well, here's our top story. There's lots of uncertainty facing the crude oil market these days, with uncertain global demand and OPEC Plus planning to put more oil on world markets. But for Canadian investors, an encouraging trend has developed. The differential between U.S. crude oil and Canadian crude oil has narrowed considerably. You see it graphically on your screen there, rising from a differential of about $15 in January to about $9 right now. Now, that's a different version of West Texas Intermediate crude than we usually look at here. The differential between the grades that we typically look at here is about $10.50. But what's important is what you see graphically there. As that line rises, the differential between the two grades of crude has narrowed considerably. Let's talk about it with our featured guest of the morning. He's Ryan Bushell, Chief Executive Officer and Portfolio Manager at Newhaven Asset Management. Ryan, thanks a lot for coming in.
Thanks for having me, Paul.
How important is that trend to Canadian investors?
I mean, it's an encouraging trend. It's what a lot of people would have thought with Trans Mountain coming online. It's interesting this year, obviously you had the bombshell tariff announcement sort of January, February, that took differentials wider as people thought, oh, okay, now this is going to back up some crude into Canada and it'll have to go elsewhere. And I never ascribed to that. I always thought, again, there's no substitute for Canadian crude, and especially into those Midwest refineries. They're landlocked. They can't get crude from anywhere else, and they're set up to run heavy from Canada. So they're price takers in that environment, and in my view. And so it's narrowed back into basically all-time low levels. And what that says to me is that the oil market is tighter than you would be led to believe by the headlines.
Mm-hmm. Expand on that.
Well, and I'm a pretty avid watcher of the energy market and energy markets globally, not just oil, but all forms of energy. I'm no Eric, I won't profess to be Eric Nuttall, but I do watch it pretty closely. And it's very interesting with OPEC adding, 1.2 million barrels over the last 3 months, combined with trade deals that are not really going anywhere. There's a lot of optimism this week. U.S. and China are talking again. There's a lot of thought that either Trump will back down. There's some thought of that, or that basically just these two economies are too reliant on each other not to work together, and so common sense will prevail. I think that's a very shaky assumption in 2025. So. If that were to break down and you have OPEC continue to add barrels to capture market share, combined with the fact that Trump and Bessent have both said they want oil prices in the 40s.
Right.
It's pretty surprising to see them at 65, and it's pretty surprising to see a Canadian differential. Again, still landlocked oil for the most part at the end of the pipe, trading at historically low diffs.
Right. What do you think of the share prices of big Canadian producers? I believe you are a long-time holder for your clients of Canadian Natural Resources, correct?
Yeah, that's right. And so the prices of the shares are kind of in the middle of the range. Another thing to consider with these differential moves is there is seasonality to this, right? We're entering the summer driving season for the U.S. Refineries pick up activity at this time of year, a little bit in advance of it. And as well, you've got oil sands turnarounds, which usually do come sort of in the spring as well, and sometimes in the fall. So that sometimes limits the supply for a period of time. So it could just be seasonality that we're seeing as well. But as you can see on the chart there, the share price is in the middle of the range. It's not very demanding in my view. We're happy to add at these levels to Canadian Natural Resources. That's our pick, but Suncor, IMO, you're going to see similar stories. Again, these companies have massive free cash flow. They're paying down debt aggressively. They're increasing dividends. They're buying back shares. To me, globally, amongst all industries, but especially within the energy industry, the Canadian oil producers look pretty darn solid at these levels.
You've made the point in the past in response to viewer questions on this program that oil prices are not too low for these companies. They can do just fine at these prices, and given the U.S. CAD exchange rate as well.
Yes, exactly. So that has moved away from these producers by 3 or 4 cents recently. We got down to 67, 66 cents against the U.S. dollar. Now we're back over 70. So that's been about a 5% move against the producers. producers. But yeah, you know, at $65 WTI with a $10 differential, and you slap on a 70 cent roughly exchange rate, you know, we're in the mid to high, you know, $80 to $100 barrel range, which again, the last time we were in that range, the Canadian dollar was par, right? So people have this anchoring of like, well, crude prices are low, so oil prices are low. Well, in Canadian dollars, that's not the case. We're doing pretty much as well. We're in certainly in the top quartile of oil prices for these producers. So very healthy at these levels. I am nervous about the oil price, frankly. I don't know if this will last. I think there's a lot of factors out there that could take things the other way, but maybe we'll talk about that a little bit later.